Let's add another voice to the conversation. Greg Gibb is chief economics commentator and deputy economics editor of the Wall Street Journal, and his latest article is titled "The Jobless Boom Has Arrived." And you talk about how disconnected the stock market is from GDP and how the jobless boom feeds into that. What's the driving force behind that gap?
So I think it's interesting. The last 24 hours perfectly illustrate what I'm talking about here. The S&P hits a new record yesterday. This morning, we learned that retail sales, the marquee indicator of how the consumer is doing, are down. Now, I don't want to make too much of it. As Steve said, it's just one number. But you have this really interesting disconnect where the market keeps romping to one high after another. Tariffs, forget about it. Oil prices, who cares? We're up 13% on the S&P. And what I think is really interesting is that it's not just like valuations going up. It's earnings. I mean, earnings are up actually even more than the price index. And what I think you're seeing here is a lot of euphoria about the economic prospects of the United States, a lot of it AI driven, just gripping the market and showing up in earnings. And yet it's not translating through to job creation. We saw that jobs actually declined in July. That was the fifth time in 12 months. The weakness of job growth is something we rarely see out of recession, outside of recessions. The bottom line is we are in this very unusual situation now where we seem to be able to grow the economy at a fairly brisk pace. You know, the leading corporations super optimistic. It's not translating into hiring.
Do we tend to see that with big technological innovations where companies aren't necessarily hiring, they're not necessarily firing because they want to see how the technology plays out? Meantime, they're investing a lot to really wrap their heads around that technology. I mean, is this something that is unique to the AI innovation boom, or is it something that is typical in history?
That's a great observation. It's a great observation, and I actually think it is unique to this one. I mean, if you go back to the 1970s and 80s when the PC came along, you didn't see weak job growth like this. And the dot-com boom, the late 1990s, early 2000s, was a terrific period for job creation. And I think the reason why is that technology was seen as complementing what businesses did with their existing workers. Hey, you're providing a service physically, let's find a way to do it virtually. Much more so with AI, you hear a lot of talk about how it replaces what people are doing. Now, if you listen to the conference calls, businesses have stopped talking about, oh, we're going to lay all these people off. Instead, they're talking about how, oh, we're going to retrain people, or we're going to take the jobs that AI now does, and we'll move those people elsewhere. So that's not quite as negative a story. But the bottom line is the result is the same, not much hiring. And indeed, the hiring rate today is about half of what it was in the years before the pandemic.
Steve, you had a question?
Yeah, well, I just want to make a point, something we've been talking about a lot, and I really enjoyed Greg's column yesterday. And the question you ask yourself, is this cyclical or secular? Is it raining today, or do I live in Seattle, is sort of the question you may want to ask yourself. And I think when it comes to job growth, we might be living in Seattle. And one thing that's a huge factor in all of this has been population growth and what's happening on that side. We need to learn to live in a world where the numbers that we get excited about when it comes to Jobs Friday are on the positive side of zero. I was not very concerned when I saw minus 23,000 about the cyclical nature of the economy. I was more concerned about what it is to learn and to live and to prosper in a world with no job growth. And that's the normal. And it makes me nervous that there are a lot of businesses whose business plan is based upon population growth. That's going to go away. They're going to learn to make more money based upon their increase in productivity, perhaps taking market share. But if we're going to run the kind of population policies that we have with the kind of fertility rates we have in this country, then, you know, minus 23, that's a shrug. Plus 50, that's something to get excited about when it comes to job growth. And I think Greg has really put his finger on something that is a cyclical discussion. What's happening with the economy? But it's also a secular discussion. What's the long range here? Well, population growth tells us that the long range is no job growth is going to be the normal.
So Steve, I think you're half right. Part of this is secular. The fact that we have very low job growth, but the unemployment rate is staying low, that's exactly because of the facts you pointed to. We have very low population growth, virtually zero immigration. But within the numbers, we also see it's not just that the supply of labor is weak, so is the demand for labor. I mean, if the demand for labor were strong, we should see bidding wars for talent. And we don't see that, right? We have hourly earnings up only 3.2% from a year earlier. That has steadily declined. It's the lowest since just before the pandemic. If you look at things like job vacancies on Indeed, if you look at things like the number of people who've been unemployed for over 26 weeks, that's been going up. So I don't dispute that we have a secular decline in labor force growth. But layered on top of that, you definitely see very tepid demand for labor. I think that might be a little bit of the secular story we're talking about.
I'm going to agree with you and undermine my argument further by saying one of the things I've been looking very closely at is trying to find wage growth. If the people who did some of these jobs are no longer available to do them, then you should see some wage growth. And I talked to ADP yesterday, and they gave me some exclusive data that looked at what's happening to job changers. And in the construction business, job changers, wages are up 13.7%. The same is true, by the way, in manufacturing and in natural resources. These are two areas where we're starting to see wage growth. So my question right now, when I asked myself about that, and I looked at the official BLS data, is maybe the data is not picking up what is happening in the economy. But I would just say stay tuned on that, Greg. If the secular story of low immigration is a major issue, and by the way, I would instruct everybody out there to call up the NFIB report, where finding quality labor is the number one problem. And there is a full page of commentary from business owners right now about the difficulty of finding it. So I would expect to see higher wage growth in some of these areas. And that creates an issue for the Federal Reserve. First of all, it's great to have higher wage growth. That's a wonderful thing. But it also creates an issue as to whether or not the job market is or is not going to be a source of inflation for the Federal Reserve.
And
Steve,
then also,
if I could just make one. Oh, sorry, go ahead.
Go ahead, Greg.
Oh, I was going to point out that one of the things we're seeing in the stock market is steadily widening margins. Okay. So what we're seeing is that as revenues go up, companies aren't hiring. So more and more of that revenue flows to the bottom line. I realize there are some one-offs, things like investment gains in Amazon. Maybe there's some tariff refunds going on, maybe some like tax benefits and so forth. But the picture is clear. We are in a world where profit margins keep going up. They've been going up for years. So to your point, Steve, if you're an owner of capital, this is a great economy and AI will make it greater. If you're a provider of labor, not so much.
And what calculus should the Fed be making with regard to kind of the unprecedented nature of the labor market right now and its tenuous position with regard to hiring in terms of hiking rates? Does that have any impact or any bearing on the trends that you're seeing?
Historically, it has. Historically, the number one thing that Fed chairs and their staff look to for tightness in the economy and economy overheating was the labor market. They would look to see the unemployment rate dropping. They would look to see wages going up. They would look to see vacancies exceeding the number of people looking for jobs. That's not happening now. And yet we still have this sticky inflation. So this might be a scenario, and we've heard a lot of Fed officials actually say that the labor market is not where they're looking for sources of inflation. They're looking at things like the AI boom driving up the price for tech and so forth. They're looking at the Iran conflict pushing up the price of oil and other commodities. And they're looking for whether companies are still trying to pass through some of their tariff costs and so on. This might be, I'm just saying, and I emphasize might, a situation where it's prices that lead wages, not wages that lead prices.